Okay, so now diving into the good stuff. We're now diving into scenario number 2, and that is if the non-monetary exchange lacks commercial substance. So it might not be explicitly stated in the question that the exchange lacks commercial substance. They might just tell you that there are no expected changes to future cash flows, right? The whole idea of having commercial substance is that future cash flows are expected to change if that commercial substance exists. So we are addressing the same two primary questions when the non-monetary exchange lacks commercial substance. We are still calculating the gain or the loss, and we are still determining the basis in the asset received. Only making these determinations will be slightly different if the non-monetary exchange lacks commercial substance. Okay, so let's just dive right into it. We got to build some mental maps. So question number 1, calculating the gain or the loss will start the exact same. Okay, so we are still out with the old, meaning what? Meaning we're going to focus on our old assets, right? The assets that have been given up. So again, focused on comparing the fair value and the book value of that asset that has been given up. Okay, so if we're calculating Prospect Futures gain or loss from the non-monetary exchange transaction with Nikki, we're focused on the fair value and the book value of Prospect Futures truck that is going out the door. Okay, but we remember if the exchange has commercial substance, the entire gain or loss will be recognized immediately, no questions asked. Now what we're saying is that if the exchange lacks commercial substance, then gains or losses might or might not be recognized. So it depends, right? And it depends on what? It depends on the 25% test that now needs to be applied. So the first part of step 1 is calculating our gain, right? That is complete. Only this is considered our realized gain. But as we said, the entire amount is not necessarily getting recognized immediately. If the exchange lacks commercial substance, we need to apply the 25% test right after. Okay, but keep in mind, if we have a loss from an exchange that lacks commercial substance, the entire amount is still getting recognized immediately. Okay, so nothing is changing. But if it's a realized gain, like we said, the entire amount is not necessarily getting recognized immediately. So the question becomes, how much is getting recognized if it lacks commercial substance? Okay, so moving on into the 25% test. So now we are shifting our attention over to boot. When it has commercial substance, no boot is considered, right? Because the entire gain has been realized and that entire amount has been recognized. But again, now we're considering boot. And here's the deal. We have 3 scenarios for recognizing gains. So scenario number 1 is our nothing scenario. Scenario number 2 is all or nothing. And scenario number 3 is all or something. Okay, so it depends on boot, like we said. And we need to ask ourselves, did we pay or receive boot? And how much boot are we talking? So in scenario number 1, our nothing scenario, this is going to not recognize any of the gain. And it's not going to recognize any of the gain if no boot has been paid or received. Okay, so nothing getting recognized if no boot is paid or received. What if boot has been paid? So if Prospect Future is not only providing the asset in this exchange, but is also paying cash, then boot is paid. So this is our all or nothing scenario. So either the entire gain is going to get recognized or none of the gain is getting recognized. So we need to pull out our 25% test. So what are we comparing 25% to? So if boot is greater than 25% of the fair market value of the total consideration that is paid, then the entire gain is getting recognized. If less than 25% of boot paid is equal to the fair market value of the total consideration, then none of the gain is getting recognized, right? This is all or nothing. And finally, scenario 3 is our all or something scenario. And in this scenario, boot is received. Okay, so cash is being received in addition to the asset from this exchange. So now we're dividing the total boot received by the fair market value of the total consideration, right? The asset plus the boot. So if boot is greater than 25% of the fair market value of the total consideration, the entire gain will be recognized. Okay, so if boot is less than 25% of the fair market value of the total consideration, well, then it gets a little bit dicey, okay? In this case, what we're going to do is we're going to take a proportional amount of this gain and recognize it, okay? So how we're going to do that is by applying a ratio. So the total boot received divided by the total consideration received will first be calculated. It's going to give us a percentage. And that percentage, right, call it 20%, less than 25%, is the percentage of the gain that is getting recognized. All right, so this will all make more sense when we go through an example. Okay, wow, that was a lot. So now thinking about the second step. Okay, so when it comes to the second calculation that we're focused on, right, determining the basis in the asset received, again, things are going to be a little bit different. Previously, we mentioned that if the transaction has commercial substance, we'll be taking the fair value approach, right? Having substance is fair. But now we're going to remember books have no substance, all right? So whether or not you agree with that assertion, that's up to you, okay? But for the purposes of understanding how to calculate basis when the non-monetary exchange lacks commercial substance, remembering this is your clue to success. So not applying the fair value approach, meaning this truck's basis is no longer going to be recorded at the fair value of the truck given up. Instead, we're taking the carrying value or the book value of the truck that is given up. Okay, so sneaky. This gain or loss is going to be included in the valuation of the new asset on Prospect Futures books. All right, so this might look confusing at a high level. So now let's go through a few examples to really run through this.
Let's take a quick break and catch our breath. Woo. If you like what you see in this video, well, you're not alone. Okay, many students who studied with Universal CPA Review have found a ton of success. And if you don't believe me, you could take a look at our reviews on Trustpilot. Trustpilot is the most legitimate third-party review site that ensures that our reviews are completely legitimate. Universal CPA Review is not only the best CPA exam study option for visual learners, but it's also the most cost-effective option out there. So if you've already spent thousands of dollars on another CPA review course, we totally understand, and we want to help you out. So take a look at our free 7-day trial and see if Universal CPA Review is for you. You can start your free trial by going to www.universalcpareview.com, or you could take a look at the link in the description of this video.
Okay, so taking a look at a few examples of our non-monetary exchange transactions that lack commercial substance. In our first example, no boot is paid or no boot is received. Okay, so on January 1st, year one, Prospect Future traded a tow truck for a building owned by Nikki Inc. The tow truck had an original cost of $50,000, accumulated depreciation of $30,000, and an estimated fair value of $30,000. The transaction lacks commercial substance. Okay, so when it lacks commercial substance, we're still running through the motions. Okay, so step one, we need to calculate the gain or the loss. So we're remembering out with the old. Out with the old tells us that we're focused on the old asset, right? The asset that is given up. So we're comparing the fair value of the truck that is given up by Prospect Future to the book value of the same truck that is given up by Prospect Future. Okay, so the original cost is $50,000. Accumulated depreciation is $30,000. That gives us a book value of $20,000. Okay, so we know that the estimated fair value is $30,000. So the realized gain is $10,000. Okay, but this is a situation where we lack commercial substance. So we're not done yet, right? The entire gain is not getting recognized today necessarily. Okay, so in most cases, the entire gain is not going to get recognized. All right, so we are going to have to ask ourselves, which scenario is this? Is this the nothing scenario, the all or nothing scenario, or the all or something scenario? Well, no boot is paid and no boot is received, right? If we just read the question, we don't see anything that has to do with the trade outside of the assets that are being exchanged. No cash is paid, no cash is received. So what does the nothing scenario tell us? It tells us that none of this gain is getting recognized today. Okay, so 0 is our gain. Now we can move on into step 2, calculating the basis, right? This is the asset that is going to the balance sheet. So when we have a situation where the non-monetary exchange transaction lacks commercial substance, we're remembering books have no substance. All right, if you want some substance, watch a movie. Okay, so what that tells us is that we're going to start with the book value of the asset given up. Okay, so the book value is $20,000. We calculated that in step 1. $20,000 is getting added to by any cash paid. We're reducing it by any cash received. And if it lacks commercial substance, we need to consider the gain or the loss in this basis calculation. Okay, but we don't need to worry about any of this. Okay, no cash is paid and no cash is received. We know that we have a realized gain, and therefore we know that none of this realized gain is getting recognized today. If this was a loss, the entire amount would still be getting recognized. but it's a gain. Okay, so none of it is getting recognized today. So the basis is just going to be that $20,000. Okay, again, this is our nothing scenario. So when we think about the journal entry, we're still going to start with the book value of the asset on our balance sheet. Okay, so when we value the building, we're going to be valuing it at its book value. Okay, so the book value of the building would be $20,000. So what's coming off our books? It's still going to be that truck. Okay, so the truck has the accumulated depreciation of $30,000 and it has the original cost of $50,000. Okay, so the original balance is going to be a debit to the truck and a credit to the accumulated depreciation. Okay, so we're reversing these accounts now that it's coming off our books. So a credit to the truck would be the original cost of $50,000. Accumulated depreciation is getting reversed, so that's going to be debited for $30,000. And that's all there is to it. Right? No cash is getting paid, no cash is received, no gains or losses to recognize. Okay, so how about scenario number 2? So what about a non-monetary exchange transaction that lacks commercial substance where boot is paid? Let's take a look. So same scenario here. Prospect Future on January 1st, year 1 traded a tow truck, but they also paid $3,000 in cash for a building owned by Nikki. Okay, so the tow truck had that same original cost of $50,000, accumulated depreciation of $30,000, and it had an estimated fair value of $30,000. So we see here that the transaction lacks commercial substance. Okay, so focused on the journal entry. Step 1, we need to determine the gain or the loss, right? This is going to the income statement. So the fair value of the truck given up less the book value of the truck given up, right? Out with the old. So the fair value we see is $30,000. We know that the book value is still going to be $20,000, right? Original cost of $50,000 less accumulated depreciation of $30,000. That's going to give us a realized gain of $10,000. Okay, but this lacks commercial substance. So we're not done, right? The entire gain is not necessarily getting recognized today. Okay, so again, asking ourselves, is this the nothing scenario, the all or nothing scenario, or the all or something scenario? Well, boot has been paid. So that tells us that this is the all or nothing scenario. Okay, so what does that mean? It means all or nothing, right? All of this gain is getting recognized today, or none of it is getting recognized today. And how do we know? Well, we're going to apply the 25% test to make that determination. So if the total boot paid is greater than 25% of the total consideration, right, the fair value of that total consideration, then all of it is getting recognized today. If total boot paid is less than 25% of the total consideration's fair value, then none of it will be getting recognized today. Okay, so what do we think? The boot paid is greater than or less than 25% of the total consideration's fair value. Well, it's going to be less than 25%. Okay, so none of this $10,000 gain is getting recognized today. Alrighty, so we have a $0 gain. Now focusing on the basis. So when thinking about the basis, again, we're remembering books have no substance. Okay, so the book value is where we're starting. The book value we determined in step 1 was $20,000, and we're going to add this by any cash paid. Okay, so we know that $3,000 is the cash amount that is paid. So the book value is $23,000. No gains or losses that are impacting this calculation. Okay, so we have a hard stop at $23,000. Now moving on into the journal entry. We have a debit to building, right? So that's the asset that is now getting recorded. And we know that the basis is $23,000. Again, the truck is coming off the books. Okay, so the tow truck had an original cost of $50,000 and an accumulated depreciation amount of $30,000. We're reversing the $30,000 in accumulated depreciation, and we are going to reverse the truck. Okay, so the credit is to the truck for $50,000. Again, reversing the accumulated depreciation by debiting it for $30,000. Do we have any gains or losses? No, we do not. Nothing is getting recognized today. Okay, so the only thing left is the cash that is paid to offset this $3,000 that is getting lumped into the basis for the building. Okay, so we're also going to credit cash for $3,000.